This video segment is a small part of what the market guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. This is AJ Monty dialing in here from Cedar Key, Florida. It's 8 o'clock. We're getting ready to go. Before we get into the main part of the webinar, I would just like to just to get a show of hands of those who are joining in on this webinar for the first time. Just raise your hand if you're a first-time attendee. There's a little icon there on the box where you could raise your hand. We have any first-timers? Welcome, Sharma. Welcome, welcome. Anyone else? Okay. We have, all right, new first-timer. Sharma, don't worry. I'm not going to pick on you. I would never do that unless I got permission from you to pick on you, of course. You could just shoot me a question or a comment there through the Q&A box. This is a very, very interesting week because we have some earnings coming out here this week that could affect the markets either in a positive way or a negative way. But from what I'm seeing here in the markets today, especially, everything that I forecasted last Friday in the weekly market report is already coming true with regard to the accuracy of the technical signals that I commented on last week. And what I like to do is just briefly go through the markets to show you what I'm seeing, and then we'll get into the individual stocks so that we could really dig in. And Bruce, what I'll do, because you and I were kind of chatting about Bank of America, I'll start off with that one, and then I'll ask questions or I'll look for stock symbols from the rest of the audience. Okay, so I'll make sure you do that. And then I may try to do something new that we did on the test warm-up here. I'm going to open up the mic for anyone that might have a question for me live. I'll open up the mic so that you could actually talk into your computer and we could interact that way. I think it'll be a lot of fun to try to do that for the first time. It worked with Chris in the warm-up. It didn't work so well with Nathan in the warm-up, but it might be just a computer issue there, and we'll try that out. Okay, so this is a chart of the diamonds, ticker symbol DIA. It's Dow Jones Industrial Average ETF. And you can see here as we zoom in, this was my forecast line from last week's market report where I projected we would move lower to fill the gap from Friday and possibly even the gap up from last week. And although this is a pretty long red candle, the thing that I see that impresses me the most, I'll zoom in a little bit more even here so you could see this. This candle has no shadow on top of the candle. And again, if you're new to the market, guys, the shadow is the vertical line that protrudes from the upper part of the candle or the bottom part of the candle. And the fact that there was no shadow tells me that the market opened up on the high and we almost closed with no shadow. So what that means is the market opened on the high and almost closed right on the low. So it tells us that throughout the whole day, from the very opening of the market, the sellers moved in and had control of the market for virtually the whole trading day. And if I go to an intraday chart showing the daily minute-by-minute chart, you'll see that that's actually the fact right here. The market right there, this was the opening of the market. This gray area right here is from the after-hour session on Friday. So this gray area was after-hour trading. And right here, again, I'll zoom in to make it clearer for you. As I zoom in, you'll see that the opening of the market was right there, right at the top of that minute candle. Remember, this candle represents 1 minute because that's the interval that I have set up. It's intraday trading from the opening to the close, and each one of these candles represents 1 minute of trading. So you can see we opened on the high, came down pretty hard right on the opening, bounced a little bit. We oscillated in this price action, but for the most part, the day was just controlled by the sellers. And you can see right here, just about 2 minutes to the close, the market had set the low for the day right there, 2 minutes before the close. And then in the last 2 minutes, we had a little bit of a bounce. But interestingly enough, look what happened after the close. See, a lot of you don't look at this, but this gray area is after hour trading. That's what that represents. And depending on which trading platform you're using, I'm using the Thinkorswim platform. Almost every broker that is out there today has the charts set up to where you can look at the after hour trading. So even after the market closed at 4 o'clock, which is right where it changes from white to gray, 4 o'clock is right there, right where my cursor is. We had a little bit of an uptick, and then boom, it got slammed again right up until about 439. That's at 439. That's what this candle represents. From 438 to 439, the market got hit in after-hour trading, and then it bounced a little bit because we do have professional traders and market makers actually trading in the after-hour session. So what that tells me is that tomorrow we're probably going to go lower again, because you can see again after hours there was more pressure on the sell side that would have if we were open for another 9 minutes, if the market closed at actually 39 minutes, if we were open another 39 minutes to 439, we would have had a big red candle with no shadow whatsoever. So again, it's a good thing to look at that periodically. You don't have to do that every day, but it's a good idea to look at that to see what's happened in the after-hour trading. Okay, so with that said, I do believe that my forecast line is going to hold true, and we're probably for the rest of the week going to trade down to fill some of these gaps. Backing up just a little bit further, what I did is I left my forecast lines on from the week before last, so you can see how we built into this rally. And again, it's just absolutely amazing how accurate technical analysis is for candle charts, especially. And I hope you're honing your skills for chart reading, because it definitely comes in handy. Now, if we look at the Russell 2000, which is a more broad-based index, remember the Dow Jones tracks 30 stocks, the industrial stocks. The Russell 2000 tracks 2,000 stocks. You can see my forecast was that we would move lower and pull back from resistance. We did that already, and we already hit my price target here, first trading day of the week, and we already hit my target. But look what happened with the Russell 2000. The Russell 2000 has a significant bearish engulfing pattern right there. So what I'm going to do is I'm going to add on to my weekly market report here, because again, we already hit my target on the lower levels. And I'm going to project, and what I'll do next week when I do the market report for the folks that are following on the market report, I'll explain to them what I did here. I think the Russell 2000 is going to go a lot lower, and here's why. Backing up so you can get the big picture again, look at this. On what day is that? That's August 30th. We closed above the blue line, which again represents the 20-period moving average. So on August 30th, we broke and closed over the 20-period moving average, and we stayed over that moving average for a good length of time. Today is the first day since August 30th that we've closed below the moving average. So that's a significant breakdown in the price action of the stock. for those of you who follow or have at least viewed my video on the 20-period moving average, Jim Rawbach, back when I was doing my PBS show on Friday nights, Jim Rawbach, who was at the time the king of stock picking, he was then enjoying the title of the Zen of market timers. He was the one that actually introduced the 20-period moving average method for trading, and that's what he used. His sell signal was generated when a stock or an index closed below the moving average, and we see that the Russell 2000 did that. So that's the reason why I'm extending this downward forecast line, because I think that the Russell 2000 could be in serious trouble here for anyone who's long the market, that is, and we could see lower prices. Now, if you're short the market, that's a great signal for you to see. You're probably celebrating seeing that if you short the market. Now, to our subscribers, for those who have been subscribing to the Option Oracle and the Equity Oracle, I have consistently told people that we will take periodic long positions, but we're going to be ready to reverse positions because we're very defensive in our stance when looking at the general markets. So again, I'm being very conservative with this kind of pullback. This is actually a breakdown like that with a bearish engulfing pattern breakdown. This could actually be a significant sell-off. I mean, I could even go out and be pretty safe in saying that the Russell 2000 could even pull back to the support level to be right around 1450. So the Russell 2000 could pull back another 47 points. But I'm being conservative in the short-term forecast that will go lower here. So be very, very defensive. Be careful of any long positions. Keep your stops in place. And make sure you're paying attention to the broader based index in the Russell 2000. Now, with that said, let me go to the spiders, which is the S&P 500 ETF. What do we see here? Interestingly enough, there's my forecast line from Friday. What did I say? And for those of you who have the weekly market report archived, go back and listen to the recording, because last Friday I said we could probably go a little bit higher and then turn lower after that. Look at this. I don't want to sound like I'm bragging here, folks. I really don't. But you gotta be impressed with these charts. Look at that. Today's high came right to my target pivot point right there. Within pennies of that. Went a little bit higher, but look at that. We went up on the opening, and then boom, we closed with this bearish engulfing pattern on the S&P. And here's my forecast for the S&P. I'll leave that in place. But that is just so impressive. And then I went so far to say down here, I said we'll most likely see a drop in volume as the buyers start to lose out of steam. So not only did I make the forecast in the pivot point that we go lower after a little bit higher, I said that we'll probably see a drop in volume, and there we go. Once again, this is like a two-tiered home run for forecasting the markets. So, you know, when I see charts like this and I go over and, you know, week after week, I show the evidence for, you know, what we're doing here. I, for the life of me, cannot understand why there aren't millions upon millions of people following technical charts like we are here. Could you imagine if the general population started following charts and reacting to signals like we see them? I mean, this would be it would be so easy to make money in the markets, because as soon as the bearish engulfing pattern shows up, what's going to happen? People would be triggered to sell out for profits or even get into new positions on the short side. And the sheer number of people reacting to the signals would drive the markets. Whether you call it self-fulfilling prophecy or not, I don't care. Hey, if I see a sell signal and I know there's a good chance it's going to go lower, I'm going to exploit that signal. I'm going to try to make money from it and then move on to the next trade. So there's the spiders. Okay. Now, I'm not going to spend too much time in recapping what we did with the forecast. So I'm just going to quickly go over the cues here with you. And again, what did I say? With the Qs, same thing with the S&P. I said we go a little bit higher. We did that today from Friday's close, okay? And then boom, I said we would most likely pull back to fill the gap. And I was very specific in pointing out that as a reason why I thought we'd go lower, because the gap right there, GAP, gap, acts like a price magnet. But that is, again, a significant candle. And I said that, again, look at the volume down below. I said we probably see a little bit of a drop in volume. Today's volume was just a hair less than what we saw on Friday. And tomorrow we might see another drop in volume as the buyers start to move out of the market. So keep an eye on that. Now, finally, before we get to Bank of America, because as I said earlier, we're going to start off with that one as Bruce communicated that to me before the webinar started. I think that the most important indicator we could be looking at is the VIX. Now, because this is still fresh in my mind from last Friday's report, I said that although I believe the S&P would go a little bit higher before going lower, I was very clear in communicating that I thought the VIX would rally right away. I didn't think the VIX was going to pull back. I said that the VIX is most likely going to rally. And look at that, Monday, we've already hit my price target. By the way, if you're not getting how I'm establishing my price targets, when I draw a diagonal line to signal the direction in which I think the market's going to go, the end of the diagonal line is my price target. So today we've already hit the price target on the VIX. And the reason I thought the VIX would go higher was because Friday we had this candle. Who could tell me what that candle represents? I'll wait for an answer rather. Who could tell me what this candle is called right there with the long shadow underneath? What is that called? Yeah, John was first to answer. Dylan was second. Yeah, that's a hammer pattern. And again, when I was going through the weekly market report last week, I pointed out this candle here with the long shadow underneath the candle. And there was one other one here. I pointed out the long shadow under the candle. When you see long shadows under the candle, what that means is that the sellers tried very hard to push it down on that day, but the buyers fought back. They fought back and won the battle at the end of the day. So when you see long shadows, especially a hammer pattern, that's extremely, extremely bullish. Now, for those of you who are subscribers to the Option Oracle, we are long the VIX through the November, I think we're long the November $10 calls, if I'm not mistaken. Yeah, the $10 strike price. We're long the VIX. So as the VIX starts going higher, we're in position here to make money on this by buying calls, which in turn go up in price as the value of the VIX goes higher. And finally, as I back up a little bit to show you, last Thursday, the VIX made an attempt to fill this gap, but came, again, pennies shy of completely filling the gap. I think this big, strong green candle is going to help us out with completing that price target or filling the gap completely. I think we're probably going to see the VIX fill the gap by the end of this week. So again, this is all being recorded as evidence to the naysayers that don't believe in technical analysis. But again, you got the evidence week after week, and I'm recording this for anyone to see, because I think it's best that I record it as proof of evidence, or evidence that technical analysis is the way to go. Okay, so here we go. Start typing in your stock symbols, because I'm going to start off with Bank of America and talk about this. Now, Bruce, is it okay if I kind of rehash or explain the question you had to me earlier today? Raise your hand if that's okay. Just give me a hands up as a thumbs up. Okay. Now Bruce is long calls, and again, let me slow it down just a little bit for the people that aren't option traders. Bruce is long what's called the leap. LEAP is an acronym that stands for Long-Term Equity Anticipation Security. It's LEAPS, LEAPS, Long-Term Equity Anticipation Security. That's what it stands for. And a LEAP is a cheaper way to get long the stock without actually buying the stock. Now, let's face it, Bank of America is not a very expensive stock, but you could either buy the stock itself and pay, $27 a share here, or buy something that moves in line with the price of the stock, and that would be, again, the LEAP. Now, Bruce asked me a question: should I sell at the money front month calls to turn it into a calendar spread, which is a strategy that allows us to take in profits along the way by collecting cash? My answer to him, let me see if I could find the, I just want to find my answer exactly, because I want to quote myself to make sure I'm getting it right. Okay, I just got my phone out now, so I'm just finding it. Let's see if I saved it. Okay, so here's my answer to Bruce. I said, Bruce, I usually don't sell anything for less than $1, because the option I was looking to sell was only trading for like 24 cents. I said, I usually don't sell anything less for $1. I would just wait for a sell signal and take the profits on the long call position. Now, Bruce, here is your sell signal. Again, what is it? That is the opposite of a hammer, which would be bullish, like we saw in the VIX. An inverted hammer, which is what we see right there, is a long shadow above the candle. That's number one. Number two, we see a drop in volume on the way up. So, see, we have a higher high today on Bank of America from Friday, but it's on lower volume. Here's the test question for the audience. Ready? What does it mean when you see the price go up, but the volume drops? What does that tell us? Who wants to be the first to answer that? I know there's a little bit of a delay. Stuart was first to answer. His answer was bearish. Greg says buyers losing momentum. Amalia was right, bearish divergence. John says buyers are leaving. Don says reversal. You're all right. You just put it in different words. When you see a drop in volume, that tells us that the buyers are losing their momentum. And when you see a long shadow, it tells us that the buyers tried to push it higher, but the sellers came back with stronger force and pushed it lower. So there you go, Bruce. There's your sell signal, but also there's a gap below the market, which tells me that the price is most likely going to be drawn back to the lower levels. So that's going to be my forecast for Bank of America, and I'll leave that up there until next month to see whether or not we were right. But Bruce, if you have a profit in those leaps, I would take them right on the opening tomorrow if you haven't already. Okay, let's go back to the stock symbols here as I go in and look for the next symbol. Okay, so Chris, I'm going to unmute you and have a little discussion here with you. Okay, so stand by as I unmute your mic. I'm unmuting you, Chris. Chris, tell me if you're come through. Do a test. You're in there? Yes, I can.
Yep.
Okay. So you gave me two stock symbols. Of the two, which is the one that's most important to you?
Costco.
Okay, so let's go Costco. Let's COST is the ticker symbol. And if you could, I always like to know what your position is ahead of time so I can help you better. Do you have a position in Costco, or are you looking to take a position?
No, I have a position in Costco right now.
You do have a position?
Yes, I do.
Okay, well, here's the good news for you. The rest of the market was down. Costco is up. And
Right.
it's not up a little bit. It's up pretty good percent. It's up $1.27. So it's up almost 1% today. And the second part of that is it closed over the 20-period moving average, with a gap above the market. You see?
Yes,
right
yes.
there?
Yes, I see it.
Yeah, so the horizontal line that I just drew would be a gap fill target price for Costco. And I wouldn't be surprised if it goes higher, even if the market goes lower tomorrow.
Good.
However,
That's good.
yeah, it's good. But here's what you got to watch out for. The negative part of this story, and it's not a big negative, but it is partial negative, is what's happening to the volume there. Can you see that?
Yeah, it's drying up.
Yeah. So it's a good strong, or I should say a good long candle with a close over the market. But you have to keep an eye on that volume, because if we get another drop in volume tomorrow, I would say, start to move out of the position, or at least sell half the position. Can I ask, where did you get long Costco?
Oh, it was a couple months ago. I can't remember exactly when.
Are you in the money on this one? You have a profitable position, or are you milking a loss?
No. I have a profit.
Okay. Well, here's the thing, and you gotta be very defensive because of the markets. Even though Costco's looking positive, we did the analysis of the general markets, and even if Costco comes out with amazing news, it could still be brought down in sympathy with the rest of the market. That's what could happen. So
that's
if
what worries me.
Profit, I would be very aggressive in protecting the profits.
Right.
You got that?
Yeah, I got it.
Okay.
I'm watching.
Now, did you have a typo in the other symbol? Is that supposed to be Apple, or is that AAOL?
AAOI. I was just watching it because I saw like 2 or 3 gaps where it gapped down, and I was wondering if those would get filled. But then I see lower gaps back even further that might get filled first. I don't know.
Yeah, there's gaps down here right around $22. Do you have a position in this one too?
No. I was just thinking about taking a position because I saw those gaps, so, and then I was thinking about the rubber band effect because it's so far away from the 20-day moving average.
Okay, hang with me here, because I'm loving this open mic concept here. This is really good. Now, for those that are new to the market, guys, the rubber band effect, and what Chris referred to, is a price divergence from that moving average. So in other words, if you could picture a rubber band with one end to the moving average and the other to the price of the stock, the rubber band is being stretched. And when you're analyzing the stock using that mental picture of the rubber band, you have to go back and look at the history of the stock to see how far has this stock dropped from that moving average in the past, where it snapped back to the moving average. You can see here, it does not like staying that far below the moving average. Right. It'll go above the moving average in a similar way where the rubber band gets stretched. But again, it does not like staying that far away from the moving average. So you can actually justify a long position here, but, and here's the but with the capital B, look back to Thursday's, what happened there? Look back to Friday's price action. See, that's a bearish engulfing pattern that follows another bearish engulfing pattern. So you have 2 bearish engulfing patterns back to back. So I don't feel that comfortable getting long this one, at least at this juncture, because of the markets and how bearish they look. This one, even though you could justify a long, I would rather you wait for the market to strengthen a bit before you jump into that one and take the long position. It's just a safer way to go.
Well, I agree. That's why I haven't taken a position in it.
Okay. All right. Great. Well, Chris, thank you so much for participating and being the first ever live mic participant here. So we'll do this again.
It was a great experience.
Thank
you.
Much, welcome to the family. Thank you.
Okay. All right. Bye-bye.
All right. Bye. Okay. So there you have it. This is how we're analyzing the stocks. Now I'm going to jump right to John. Because John is looking at Ciena, CIEN, and I'm going to go right to that. I don't know if any of you can see John's question, but John's question to me is, will Ciena fill the gap? So let's talk about that for a second. Ciena has a gap here and a very, very small gap here. Let's take the first gap right here. Ciena, like what we just saw in Costco, has some green showing up on the candle. So in other words, here you have a NASDAQ stock showing a positive price action for the day, while the general markets have dropped with significant downward pressure. And here Sienna has closed above the 20-period moving average. Now, do I know with great certainty that the gap will fill? No. But what I can say is that there's an 80% chance that the gap will fill. Again, we have to treat this one just like Costco and say, you know, this one can start to go lower if the general market gets pounced for the rest of the week. So John, I don't know what your position is, but if you do have a long position, I would be aggressive at protecting any profits, or at least limiting any loss in the stock. I would put a stop on that one, John. If you have a long position, I would put a stop right below that support level, right there, right around 21.07. That's where these lows are. So keep a stop on that one, and don't even hesitate to get out if it starts breaking down below support. Okay. All right. Let's see. Does anyone, if you could just all lower your hands for a second, and if anyone has a question they want to ask me live, then raise your hand again, and we'll try this. And again, we tested it with Chris, so I don't know if it's going to work for just anybody, but let's see. Herschel, do you want to try it out? Let's see. I'm going to unmute your mic and see if we can get a question out of you. Let's see. I'm going to unmute the mic. Herschel Stocks, go right ahead.
Okay, thanks, AJ.
It's working.
Nice to talk to you after a couple of years of following you on the Scotia website. I'm interested in Hertz, HTZ. I've got some November, I think they're $22 calls, and I'm still hanging in. Nope. They're they are 2250 calls, and oh no, they're puts. Sorry, 2250 puts, and I'm hanging in there until the expiration date. Would you keep hanging in?
Let me just probe a little bit more, like an option detective would. Now you're long the puts?
I am until November.
Okay, now here's the thing. Normally, and you could really confirm this with any of the option Oracle subscribers. Normally, I don't buy front month options, which in this case is now a front month option because last Friday was expiration day for October.
AJ, can you hear me?
Yeah, I could hear you.
Yeah. Oh, good. No, I'm not long. I'm short the puts. I had to check my chart there.
Oh, okay. That's a whole different. Okay, that's better. I feel better now because we normally don't buy the front month options. We'll sell the front month options. Now, what I would say is on this one, because being short a put is actually a long position. You have exposure to the downside. Okay. Now this was a play. This was a hurricane play. When I first started talking about this, when Hurricane Harvey was hitting Texas, because at the time people were renting cars because their family cars were flooded or destroyed in the hurricane. So Hertz was actually benefiting from that. So if you short the put, your exposure is to the downside. So if you're short the 22.5 puts, you're going to be starting to lose money just below 22.5. Okay. Now, the good news for you is that although we have a red candle here, it's on low volume. So it doesn't look like to me like the sellers are extremely motivated at this point. So what I would say is don't look too much at the price, look at the volume. And if tomorrow or Wednesday or Thursday you see an increase in this volume down here, that means that the sellers are becoming motivated. And at that point, you would get out and eliminate the risk by closing the put position. There's no need to hold on if the sellers are picking up momentum, because that means they could hurt you. it's kind of like being a quarterback on a football field. You see the lineman rushing in a blitz, get out of the way or defend yourself, and that's what's happening. You're going to be exposed to a price blitz, if I may use that analogy. You're going to be exposed to a price blitz if this volume starts to increase.
That's okay. AJ, because I'm 117% on those puts so far.
That's beautiful, but the old saying is, don't turn a winner into a loser. Right. Yeah. So if you see the increase in volume, take the profit, run, wait for the next entry point. I'm going to be watching Hertz pretty closely on my watch list, and it's a fun one to trade because it's not an expensive stock to trade, but it also has good option play in it for the option traders.
And good legs.
Yeah, exactly. Herschel, thank you so much for participating. I'm going to put you back on mute, and we'll go back to the show here. Thank you. Okay, now, this is a lot of fun for me. I love interacting with the folks rather than reading the Q&A box. But I don't want to abandon those who are not unmuting. I'm going to go right to Bob because Bob is looking at XLF, and he's looking to buy if it fills the gap. And I know where this is going, Bob, so let me pull up XLF. The gap is, I guess you're referring to the first gap that occurred on Friday. Is that right, Bob? Just type in a yay or a nay on that one. Now, you got to look at this one because this is a spider trust that tracks the financial sector. And I wouldn't necessarily rush into this one on the long side because, again, if the general markets start to come down, especially the Dow Jones Industrial Average, this gap could fill all right. I'm not too concerned about it coming down to fill the gap, but whether or not it's going to bounce off of that gap fill point is a whole nother story. So I'd be really, really careful. I would wait for this one. I would watch it. It's you got these spinning top. The spinning top up here is a sign of indecision. So I do think that the stock is going to pull back to fill that gap. And by the time it fills this gap, this moving average is most likely going to start to move up as well, because that moving average will keep going up for as long as the price is above the moving average. But if the stock starts dropping down below that moving average, that's when the moving average is going to turn lower. So this is more of a wait and see to see what happens after it fills the gap. And for those of you that may not know the gap rule, it's a two-part rule to gap trading. Number one, there's an 80% chance that the gap will fill, but the other 80-20 rule that goes along with that is once the gap fills, there's an 80% chance that the stock will bounce from that point and go the other way. So right now we have to wait to see if it fills, which I think it will. And then part two is, will it bounce? Now, Bob, if it does bounce, if you do get that bounce off of that gap fill point and you're buying in at around the 2630 level, you would put a stop right below that newly established support level here. So in other words, if you buy it at, let's say you buy it at 2640 even, you would put a stop right below that, maybe 2610, maybe $26, give it a little bit of room, and then protect yourself on the way up. Okay, so hopefully it helps you out. Let's go right to Don. Don is looking at NVIDIA. I think I'm right, in NVDA. And Don, if you could, let me know if you have a position in any of the stocks that you submitted to me, okay? Because I could do my analysis, but it's always good to know what your intentions are so it can help you better during the analysis of the stock. Okay, let me go and see if Don is in there. Okay, did you answer? Oh, okay. No, Don, I'll wait for your answer in there as I go to the to stocks. Okay, now NVIDIA, like my gut is telling me it's going to pull back. Like that's like my analysis at a glance. And the reason I think it's going to start pulling back is because you got these red candles showing up. As the stock is going higher, the volume is dropping. So there you go. The momentum is drying up. Hard to see because those bars are so small. Don't let that fool you. In the video, it trades 10 million volume a day, no problem. So, but don't let that fool you, because that's still significant volume, because it's a high price stock. There's a lot of money coming in and out of this stock. This back in the day, back in the tech rally right before the crash, or I should say the tech bubble burst, NVIDIA was one of the hottest stocks to trade because it was trading $40, $50 a day up and down. It was just like a trader's dream to be getting in and out of the stock. So what's happening is this stock could most likely pull back towards this moving average, because the buyers are starting to weaken, and it's hard to see, but you got a very minor gap right here between this high. That high is 186.73. So if this low is not down to 176.73, which it's not, the low is 187.26. So it's got about a 50-cent gap right here. So what's most likely going to happen is the stock is going to pull back to fill the gap, and then I would expect a bounce at that point. Now, again, it doesn't look like much on the chart, but that would mean that the stock has to pull back $10 before we even think about the bounce. So be careful of that one, okay? Because if you decide to take a long position right now, Don, that could bite you. I would wait for the bounce. All right, now I'm going to take just one more, because we have a lineup of stock symbols. Don, I'm going to look at FB, at Facebook on this one, because Facebook is so popular. Facebook is trying something new today, and I don't think investors liked the strategy. What Facebook is looking to do is they're looking to charge the news agencies to post on Facebook. So think about that for a second. It's almost going to be like a pay to play. That's one of the headlines that I read today about Facebook, is that they're going to try to charge the news agencies. They're going to try to charge for them to play on Facebook and put out the news. I'm not crazy about that. I'm not crazy about that, because a lot of these news agencies might just back out and say, heck with that, I'm going to go to Twitter or Instagram or Gab, which is a new one popping up. Gab social network is coming after the Facebook crowd. So I don't know how that's going to pan out. So be careful of Facebook. Fundamentally, the story looks very bearish, but technically the signals look very bearish too, because look at this big red candle. That red candle happened on slightly higher volume, which is telling us that the sellers are heating up now, and it closed below that 20-period moving average. So my forecast for Facebook is going to be down here. I think that thing could drop at least $6 from here. Okay, so be careful how you position yourself. Don't just rush in and try to catch a falling knife, because that could cut you there. Okay. All right, let me go on, because I'm kind of falling a little behind on my analysis. I'm not doing it as quickly as I used to do, like last month. Okay, now Antonio is looking at ABX. Now this is Barrick Gold. Barrick Gold is a widely held stock by the institutional traders. And before I get into ABX, I want to tell you that I do hold a significant long position in gold and silver. I'm a buyer of gold, and I'm buying gold in physical form. Actually, I'm buying 1 ounce gold coins from Provident Metals. That's my preferred dealer online. There's a number of them, but Provident Metals is giving a good deal on the gold coins. And I bought some more gold last week, and ABX is a gold stock that many times is inversely related to the Dow, because it becomes a safe haven when there's questionable price action in the Dow and the major indices. Investors and institutional traders tend to move into the gold market and silver for that matter. So look what happened with Barrick Gold today. I love it. Now, again, Antonio says he owns it and would like to buy more. Well, I would give you the green light to do that, because what does that 2-day pattern tell us right there? Go on to answer that. What's that 2-day pattern look like to those who've been following the Market Guys videos? Anyone want to answer that? Let's see, a little bit of a delay. Yeah, Greg, Stuart, Charles, you're all right. Sherman, it's bullish. It's a bullish engulfing pattern. Now, what's most significant is that bullish engulfing pattern follows a bearish engulfing pattern from last week. So although the bearish engulfing pattern resulted in lower prices, it didn't hold very long. Boom, the buyers came right back in here. So I'm going to forecast that Barrick Gold is going to start moving up. So what I would say to you is I would not only hold on to your long position, Antonio, I would add to the position. And it's a fairly inexpensive stock to do that. So with that said, you have to also set a stop level. I like to give Barrick Gold a lot of room. So if I bought more, even at the 16-15 level, I would give it room and probably put a stop somewhere down here below 1540. Give it enough room to oscillate. I think it's good. And also, Antonio, I would look at Barrick Gold, but I would also, on your watch list, I would put GLD. These are the two ones you want to add on to your watch list. GLD and IAU. IAU is like a lesser version of GLD. And you can see all of these gold stocks here are showing bullish engulfing patterns. The significant thing about IAU, and remember, Barrick Gold is going to move in line with IAU. IAU filled the gap today with a bullish engulfing pattern. Now, I kind of gave away a free trade candidate here for the non-subscribers, but that IAU is a beautiful stock to go long right now, because this one could go right back up. And although it doesn't look like much on the price scale, to be able to pull, I don't know, you pull 50 cents out of a $12 stock, you get a good percentage of gain there. Okay, so you're talking, what is that? Probably 4% if you get a 50-cent move on $12 stocks. That's pretty good. Actually, that's more of like a 6% move. Okay, so Antonio, I hope that helped you out. And I'm going to go right to Ron, who's next in line here. And then for those, if you can, all of you lower your hands, because I'm going to ask for another volunteer to go live with the mic. If you could all lower your hands, and then I'll ask for a volunteer to do that. We'll go right back to the open mic. Ron is asking T, which is ticker symbol for AT&T. AT&T is obviously a communication stock that has a lot of volatility. This is a really good stock to trade. And Ron is asking, would this be a good entry point? Now, like I mentioned with the other stocks, Ron, you got to really look at the domino effect and how the markets are going to affect a stock like AT&T. AT&T, at first glance, my gut is telling me it could very well be a good entry point, but I don't see any green candles yet. I think the safe bet, let me just, actually, before I do that, look, back here, this is an old forecast. Back here, I forecasted that we would most likely get a bounce, and look what happened. It gapped up back here. So I'm going to erase all my lines on AT&T, and again, help Ron out with the forecast. In order for me to do that, I'm going to go to the weekly chart first. I want to try to find a significant roll reversal on the weekly chart. And it looks like there's one back here. Okay, again, here's my weekly roll reversal. Roll reversal, R-O-L-E, roll reversal. That's when you have a former high that's broken, former resistance turns to support. And the reason I'm pulling that one up, Ron, is because if you take a long position, that's the line you're going to use to manage the risk. All right. So if you buy the stock on the pivot point or a green candle, you're going to try to set a stop somewhere below 34.70. That's going to be your risk point. Okay. Now that I have my roll reversal support line drawn on the weekly chart, I'm going to go back to the daily chart and kind of scrunch it a little bit there. Okay. So what you want to do is you want to wait for a green candle. So this is like when I put out a trade alert, a lot of times I put out a contingent buy alert. So Ron, you're going to have to set your own contingency plan here on this stock. Because again, I think the general markets are going to go lower, which could drag AT&T down a little bit. So here's my forecast for AT&T. I think it's going to go down a little bit more before bouncing. Now, on the bounce, or when it's at that low pivot point, you're going to look for either A, a green candle, B, a candle with a long shadow underneath it, could be a hammer pattern, C, a doji or a spinning top. That's okay to get in on a doji or a spinning top. And if you get any of A, B, or C, as soon as you buy in, you're going to put your stop in place. So there you go. It's kind of like if you bought the book, the 5 Points for Trading Success book, that's the plan. You want to look for a key level support. You want to wait for the pivot point. You want to take action. You want to set the stop, right? You got all that. And so you're going to follow the 5 Points for Trading Success on this one, but you're going to wait for the pivot point instead of try to pick a bottom on that one. All right? Took a little bit more time than I probably should have, but Ron, I want to help you out. Okay, like I said, who wants to be the first one to raise their hand? Try the open mic with a question or a stock symbol. I'm looking. It's kind of like spinning the wheel. KV. Now, you have two initials there. I'm going to pick on KV. Here we go. See, unmute KV. There we go, KV. You're live. Can you hear me?
There
we go. You're live. KV, what's your first name? I hear the open mic. Don't be shy. If you have a question, go ahead. Oh. Okay. Guess not. Lost KV. We're gonna mute KV's line. Okay, who's next in line? Who had the hand up? Oh, look at all these shy people. Come on. There's got to be some New Yorkers on here somewhere. All right. Jeffrey. I'm unmuting Jeffrey. Jeffrey Summer. Let's see. Oh, you live? Okay. I unmuted you, but I don't hear your mic on. Usually I hear some background noise. So if you've got your microphone muted, Jeffrey, try to unmute it. I'm going to leave you unmiked. And if I hear your mic come on, I'm going to come back to you. I'm just going to leave it open. Okay. I'm going to go back to the Jerry. Jerry is looking at Target, TGT. Let's take a look at this. TGT is in the same category of the retailers. And some of the people call this one Target for the discount shoppers who want a little bit more class to the name. Now, here's the thing. Jerry is long the January 55 watt calls. Okay, long call January 55s. So Jerry is long an in the money call. It's up nicely. And the question is, should I go ahead and take the profit, or do you think the gap to 65 will fill? All right. Here's what I think. I like the candle. It's green. I like the volume on the candle. It's higher. So your answer or your action plan will be based on what you see in the volume tomorrow. Now, here's what I think is going to happen with Target. I think it's actually going to drop. Why? Because of that shadow. You see that long shadow? And if you look back at the past, I'm going to search here. See, when you see long shadows on Target above the candle, let's see if I can find another long shadow. Here's a long shadow back here. See that long shadow? Most of the time, I'm going to say close to 90% of the time, when you see a long shadow above the candle, it generally means that the sellers are moving in. So I don't know. My gut tells me I would probably sell it on the opening. I wouldn't even wait for a red candle or lower volume. I like taking profits. Jerry, there's something about taking profits that just puts a smile on my face. I love it. It makes me feel good. You know, I come home after taking a profit. My wife knows I'm happy. We go out to dinner. We celebrate the profits. You know, I like taking profits. I don't see anything wrong with you taking profits. Now, if you don't want to take all of your profits, you could take half. Sell half the position immediately, bank the profits, and if it drops back down, you could buy the calls back at a cheaper price and wait for the next pivot point after there bounces. So that's my spin on target. Okay, so Jeffrey, I'm going to take you off mute because I don't hear the mic coming on. So I'm going to mute the mic rather, okay? And let's go right to Greg, who's looking at Netflix and CMG. Now, NFLX, we have a position in this one. The option traders do at least. And we have a position in CMG. Netflix is already back at the 20-period moving average. And it's very, very close to being at that role reversal point. Now, I think Netflix could actually go a little bit lower. I think what we're going to see is a drop below that support level on Netflix. I think it's going to breach that because of the general markets. And it's just so close to that moving average. And, you know, what's catching my eye is the increase in the volume here. See how the volume went up on the red candle? That's not a dramatic increase, but it tells me that the sellers are starting to get a little motivated there. So tomorrow or even on Wednesday, you might see a close below the 20-period moving average, which means it's probably going to come back to fill that gap. Now, I'm looking at the clock. I got 4 minutes left. I want to get to the CMG analysis. We're long CMG, okay? But as I said in the option article, there's a bullish engulfing pattern last week. So I think what's going to happen with CMG is it's kind of going to stay in this price channel. What we did is we sold the 360 calls on this one because to take some cash into a long position. So we took some cash by selling the 360 calls. Hopefully you did that, Greg. And now, again, with further analysis, I could see that there is this long shadow above that red candle. So CMG is probably going to drop just a little bit. I don't think it's going to drop like in a big way. I think it's going to come back to this role reversal level here, find support at the 20-period moving average, and then maybe bounce. But it's definitely stuck in this big trading channel. And so that's what's going to happen. It's going to stay in the channel. We could trade it. We'll do the calendar spreads, have a lot of fun, take the money in, and then use those profits to fund other positions, whether they be losing positions or winning positions. We'll use that cash to fund those positions. Now, before I wrap things up, I'm going to tell you, it was pretty hard typing. I still have a cast on my hand, actually. I almost chopped my finger off with a chainsaw, believe it or not, from Hurricane Irma. Embarrassed to say that, but I still have the cast. So I'm getting my pin out of the hand on Tuesday, and I'll be back to normal on typing more detailed reports. Kind of hard to type with one hand, but I was doing that for the option article expiration week alert, and it came out okay. But I want to tell you that I am on a mission to drive membership, and I was thinking about this. If anyone has a trading buddy, a relative, or family member who is interested in trading the markets, if you're a subscriber, I will, if you give any referrals to us, have them come directly to me, your name. I'll give you the month free for that month on the referral. And if you're not a member, but want to be a member and you have a referral, I'll give you your first month for free. Okay. The reason I want to drive membership is because sometimes I scratch my head especially when I'm doing the weekly market report at the end of the week, and I'm thinking there is no one in the world that has a better percentage of accuracy for predicting the markets. and I want to drive membership because the more members we have, the more effective the signal becomes. And I don't want anyone to misinterpret this. I'm not trying to manipulate the market, but you've seen it over and over again where you turn on Fast Money and you turn on Jim Cramer and he'll make a recommendation and immediately the stock will move. But unfortunately, his long-term forecasts aren't as good as mine. He moves the market immediately as his lips move on screen because of the sheer volume of people that react to his recommendation. What I want to try to do is build the community of technical analysts, so to speak, or technical traders, so that when we see the signal simultaneously, it's the signal on the chart that's driving the price action. And in turn, because we have a larger group of people following the signal, we all make money together. Does that make sense? So the percentage of us making money goes way up because of the numbers of people driving the signal. So that's why I'm going to continue to build the membership on this and drive the audience to our alerts so that we can all make more money. That's the whole point. If you're trading the market, don't you want to be making more money? Just makes sense to me. So again, if you have someone that wants to subscribe, have them call me. I'm gonna give you my number because this is a member. It's a closed session here. I don't put this out on the web at all. Write this down. My number is 407-921-7884. Please don't blast that out on the social networks. That's for you and you alone and for your guests who you're inviting to the service. So it's 407-921-7884. Have them mention your name. We'll get them enrolled. You get the month for free and everyone's happy. Okay, so with that, I'm going to sign off. I went a minute over. Hopefully, Kenny, who's recording this, isn't going to have a problem with going over. But I want to thank you all. I had a good time today, especially with the open mic. Looking forward to talking to you next month. Have a good one. Signing off. Take care.
This video segment is a small part of what the market guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.